Man, a topic that we have that we always get questions about that's powerful is capital gains. So the basics of capital gains, I want you to understand, they primarily relate to investment properties that we own or you own. And the key thing is that once you buy a residential property that you're deeming investment as a rental property, then you're automatically subject to capital gains. So let's just say, for example, in 2015, you bought a property as an investment or rental property, single family home. Let's say you bought it for $500,000 and then you sold it in 2020, 5 years later, for $700,000. What was your gain? $200,000 is your gross gain. So automatically you're subject to capital gains on that $200,000. Now, there's deductions that are taken off, expenses that are taken off, closing costs that are taken off. But the government wants to understand how much are they going to tax you based off of that net gain. So $200,000 minus $50,000 in closing costs and expenses and rehab on the property. So your net gain in that situation is what? $150,000. Now in that situation, you're subject to capital gains taxes, state and federal. Now what's a great way to avoid capital gains taxes? 1031 exchanges. So 1031 exchanges are when you have a net gain in the situation like, let's say you've sold a property for $700,000, you bought it for $500,000 years before, and your expenses while holding the house were $50,000 like we've talked about, so your net gain is $150,000. In that situation, if you don't do what's called a 1031 exchange, and you just straight sell an investment property that's subject to capital gains taxes, then you have to pay state and federal taxes on your $150,000 net gain in that situation. Now the 1031 exchange is awesome because it's a 1031 exchange tax code in the IRS and our tax code in general that allows you to take that property, sell it, and then find another one simultaneously and move the equity over so you do not have to pay taxes at all. You're deferring them to a later date. Now, let's talk about how the 1031 exchange process works. Let's say today I sold a property for $700,000 and I want to be able to move the net equity I have in that investment property I sold, and I want to use a 1031 exchange tax code to be able to move that into another property. Rule number one, I have to be able to sell the home and I got to find something that's of equal or greater value. Number two, when I sell that home today, let's say, and I close today at $700,000, I have to identify up to 3 homes that I'm going to buy within 45 days of closing home 1. So I close home 1, and then I have to find and identify 3 homes within 45 days of that moment that are equal or greater in value. And then number 3, I have to be able to close on one of those 3 homes within 180 days after I identify. So there's specific rules that the IRS has laid out for us as investors to be able to defer taxes to a later date, take investments and trade them basically for better investments, and not have to pay immediate capital gains taxes to the IRS. The key thing that I want you to be able to understand today is that you can buy investments, you can make profit, and you can avoid paying taxes to the IRS until a later date. So be very informed when it comes to capital gains.